silver is such a small market. I think at current prices, you're looking at maybe 30 billion total production worldwide for a year. It's just such a small market in relation to gold. And you can't have silver exploding. You couldn't have $200 silver, in the short term. You couldn't have $200 silver and $3,500 gold. I mean, the ratio would completely collapse, and that would lead to a failure to deliver. If silver goes failure to deliver, I guarantee you within 72 hours, so will gold. And when gold goes failure to deliver, the financial system as we know it is done. You could make the case that there's 200, 300 paper ounces for every 1 real ounce that exists.
The silver market is reaching a breaking point. There's a widening gap between the paper contracts being traded and the actual metal available. Lease rates, what it costs to borrow silver, have more than doubled, now pushing past 6%. That's not a small move. It's a red flag signaling real stress in the physical market. Bill Holter has been blunt about this for years. Silver, he argues, has been severely underpriced despite running a structural deficit of 400 to 500 million ounces annually. The paper market, where hundreds of ounces are traded for every real one, has kept prices artificially low. That illusion holds until someone calls for delivery and the metal just isn't there. Peter Spinas sees the same signs. Lease rates are rising because lenders are holding onto their capital instead of lending it out. That hoarding behavior usually only shows up when there's a genuine supply concern. This year's projected deficit? Over 117 million ounces. And there's no easy fix. New large-scale silver mines aren't coming online. Holter makes a critical point. If the market hits a failure to deliver moment, where contracts can't be settled with physical metal, confidence collapses. That risk doesn't stop at silver. Gold would follow, and from there, the credibility of the broader financial system gets pulled into question. Because at the end of the day, if contracts can't be settled in the real world, they're worthless. The numbers on COMEX back this up. Commercial players, mostly bullion banks and large institutions, are holding massive naked short positions in silver, equivalent to approximately 12,000 tons. They don't have the physical metal to cover it. According to Holter, if silver breaks out, rising to $200 an ounce, and gold remains around $3,500, the gold-silver ratio will collapse. Such an imbalance could spark cascading failures across the entire precious metals industry. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
My opinion is commodities for so long now, since the 70s, 80s, have been controlled by paper contracts. Mm-hmm. And what's happened is they've overshorted contracts throughout the entire commodity spectrum. And that's fine, except for taking into account the real world, real supply and real demand. So what they've done is they've priced or underpriced commodities for so long that now you've got you have structural issues. I mean, take silver. Silver's in a structural deficit of 400, 500 million ounces per year. And if you could make the case that there's 200, 300 paper ounces for every 1 real ounce that exists. That's how bad it's gotten. Utility is not the right word, because think about all the uses for silver. I mean, you've got medicinal, industrial, technological. I mean, every time they launch a Tomahawk missile, that's a monster box flying through the air. The thing with silver is that there's end use for it. I mean, when gold gets bought, gold is money. Gold gets, like Warren Buffett says, it gets bought and then it gets put in the dark and you never see it again. The thing with silver is it gets used. It gets used, and you can get some of it back, but it's only some of it or a small part of it. The structural deficit. And getting back to the importance of silver, I've said all along, and I still maintain, that silver is the fuse, if you will, to gold's financial bomb. Because when gold blows, when gold goes into failure to deliver, then you've got pretty much confidence across the world is going to collapse. Because, I mean, think about it. What's the value of a contract that cannot perform? The value is zero. So silver is such a small market. I think at current prices, you're looking at maybe 30 billion total production worldwide for a year. it's just such a small market in relation to gold. And you can't have silver exploding. You couldn't have $200 silver, in the short term. You couldn't have $200 silver and $3,500 gold. I mean, the ratio would completely collapse, and that would lead to a failure to deliver. If silver goes failure to deliver, I guarantee you within 72 hours, so will gold. And when gold goes failure to deliver, the financial system as we know it is done.
Right.
The deliveries were made. It was said back then that it was because of the tariffs. I don't really, I think gold was being onshored or brought back. Another thing that's going on that almost no one's talking about is that you have foreign central banks that are demanding gold back from the Fed. And if you remember 10 years, 12 years ago, Germany requested, 320 tons or something like that. And it took them over 3 years to do it. And at the time, they were saying that, it's too much weight. It can't be done. The logistics just can't be done. Well, we just saw that it can be done. And 320 tons, you could do it with 4 plane loads with Boeing 747 cargo planes. They can carry 95 tons each.
What if the U.S. government can't deliver the requested gold back?
That completely breaks all trust in the United States. Would you ever do business again if you were a foreigner? Would you ever do business again with the United States? And they've already come pretty close to that by sequestering Russia's $300 billion in Forex reserves in treasuries. And now they're taking the interest from that $300 billion, and they've been giving it to Ukraine to fight Russia. I mean, so basically Ukraine's fighting Russia with Russian monies. Yeah, the dollar would get smoked on that. I mean, there's no question about it. If you go back to just to get back to what I was just talking about, the Russian reserves, you go back and you look at a chart of gold, and you can see to the day, it was October of 2023, I think, when gold lifted off and came out of the range of the 1,700 to 2,200 or thereabouts. But the following day after that was announced that those reserves or those treasuries had been sequestered, gold all of a sudden kicked into, it started looking like a tractor in first gear going higher. And that is a function of trust. Foreign central banks just looked at that and said, hey, wait a minute, if they can do that to Russia, they can do that to us. We'd rather hold something that we actually hold, we know cannot go bankrupt, we know cannot be diluted. It's God's money. But I think we're going to go through at least 1, maybe 2 resets before we get to the final reset, the Mother Nature reset. The first reset, I mean, there's no doubt in my mind that they're going to try to do some type of central bank digital currency or whatever, stable coin. It's still going to be fiat. And I don't think that that's going to last much more than, I don't know, maybe 6 months. Could be less than that. Could be a little longer than that. But I think we're going to go through a reset, and they will mark the price of gold up on that reset. But we're still going to have a fiat currency. And whatever the end result as far as what the world reserve currency is going to be, it will be tethered somehow, ratio backed or whatever, to gold. There's no way that the world is going to accept the situation we're in now again.
Global debt has hit a new all-time high, reaching $324 trillion in the first quarter of 2025. That's a $7.5 trillion jump in just 3 months. As this debt pile grows, investors are reacting, not by chasing more paper, but by shifting toward hard assets. Gold and silver, long dismissed as relics, are now looking more like safe harbors in a storm. Bill Holter puts it plainly. What's coming next could be a full-blown credit currency event. That's not just a dip in markets, it's a breakdown in trust. First stop, the bond market. If 10-year Treasury yields climb above 4.5% or breach 5%, foreign investors will start pulling back fast. It would be a clear sign that faith in U.S. sovereign debt is cracking, and we're already getting close. As of Monday, the 10-year Treasury yield was ticking upward, reaching 4.416% ahead of the Federal Reserve's interest rate decision and inflation data. Holter's point goes deeper. He argues the Treasury and the Fed have no good options left. They'll have to keep printing to roll over existing debt. At this stage, There's no meaningful risk premium in treasuries anymore because people don't believe they'll be paid back in anything with lasting value. The end game, he says, is simple. The dollar gets sacrificed to keep the machine running. Let's get back to the interview.
People ask, when's the reset? And I just tell them, you're watching it in real time. I mean, think about this, Danny. Okay, so gold was $1,700 2 years ago. Now it's $3,400, double. Any asset that is the same price that it was at the end of 2023 has lost 50% of its value versus gold.
Mm-hmm.
And gold is the measuring stick. It's not the dollar, it's not the yen, it's not the euro, the pound, whatever. The measuring stick is gold. And that's why when people ask me, are we going to have inflation or deflation? Well, we're going to have inflation of the things you need, food, gas, etc., and deflation of the things you have. Not necessarily in dollars. You could see an asset, you could see a piece of property double in value and gold go up 4 times. And that thing that doubled in value has lost 50% of its purchasing power versus gold in that time. So gold is the measuring stick. What have central banks been doing for the last 2 years since the sequestering of the Russian treasuries? Central banks all over the world have been buying gold. That's about as inside as you can get.
Any other signals that you look for when it comes to gold and silver?
Because I believe that this has to be a credit/currency event. I think if all of a sudden you started seeing wild volatility in currencies, if you started seeing bigger volatility in or on the U.S. Treasury curve, I mean, this is going to be a credit/currency event. And if you start seeing, wild gyrations, or not even wild gyrations, just a movement upward. If you see rates go through 450 on the 10-year Treasury and you get a 5 handle or over a 5 handle, I don't think markets can handle that. And I think that would be a signal to foreigners that the game's over. If the Federal Reserve cuts rates, say they cut it 1%, 2%, and rates don't go down or go down very little, or in my opinion, ultimately rates are going to go higher rather than lower, that would break confidence. Now, in the real world, what does that mean? You're already looking at super soft real estate market, housing market across the country. Commercial real estate is already in the middle of a crash. Higher interest rates will smoke the real estate markets. Higher interest rates make it harder, more difficult to carry derivatives. And the world is awash. It's flooded with derivatives, and those derivatives are what price assets. You'll see derivatives begin to default, and then you get a cascade. And once derivatives default, you're talking about over $2 quadrillion worth of derivatives, which is way, way, way more than the value. It's probably double the value of every asset on the planet. So it'll be a paper bonfire, 100% guaranteed. I mean, you cannot have a sector of derivatives fail and other sectors not fail. And the reason being, it's one big, gigantic financial orgy where everybody's connected to everyone else. So if you get one entity that's infected, the entire system's infected. And understand that the problem with the derivatives chain, the way it's set up, is that if you have a contract between 2 entities and one entity wins, I mean, it's a zero-sum game. So one entity wins, the other entity loses. But if the loser loses so big that they can't pay, then the winner doesn't get paid.
Yeah.
Then whoever the winner is, whoever they're doing business with, they're going to say, hey, wait a minute, they got this big loss on their books. I'm not sure they're stable. So it spreads like that. And of course, the loser, they've gone bankrupt. So anybody who's doing business with them already, they become an immediate loser because the other side of the trade can't perform on that contract. And I've said for a while now that the ultimate goal is to get the entire earth under a central bank digital currency. Now, how do you do that? You couldn't bring that out today because the vast majority would say, no, I don't want to do that. Well, we've been inundated with all sorts of news, and I think that's only going to continue, and even the volume on that's going to be turned up. I'm watching 4.5% on the 10-year bond, and the reason being, the Federal Reserve a year ago cut rates twice, and market rates went higher. They went higher by 1 full percentage point. So here we are, you got Trump jumping up and down, berating Powell, although I think, $3 billion for 3 buildings is pretty stupid. But berating Powell because he won't cut rates. And I'm not sure that Trump understands that if the Fed does cut rates and all of a sudden we see a 5 handle on the 10-year, that is clear that the Federal Reserve will have lost control of the yield curve. And at some point in time, that's going to happen because there is no premium, there's no risk premium on treasuries. And when I say risk premium, I'm talking about, whether or not A, you're going to be paid back, and B, whether you're going to be paid back in like a real currency or in monkey money. And mathematically, that's where this goes, is that the treasuries are going to be paid back in monkey money. In other words, they're going to have to destroy the dollar to actually make the payment because they can't do it in real terms.
Yeah.
In today's dollar, in other words.
The pressure's building, and this time, it's not staying hidden. Silver lease rates are spiking because lenders don't want to part with metal they might not get back. COMEX is overloaded with paper contracts no one believes will be settled in ounces. Meanwhile, global debt continues to smash records, and Treasury yields are creeping toward levels that could trigger a foreign exit. It's not theory anymore, it's happening in real time. The market smells risk, and it's quietly rotating into assets you can touch, not just trade. So what happens when someone finally demands delivery, and the vault door comes up empty? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.